A 70% failure rate. That's the statistical probability that your children or your grandchildren will completely bankrupt the wealth you spend your entire life building.
It's a terrifying number.
It really is. I mean, they will lose the house, drain the accounts, and just completely dismantle the portfolio. So, welcome to the deep dive. Today, we aren't just talking about making money. We are talking about the actual mechanics of keeping it, multiplying it, and, insulating it from the forces that just naturally erode wealth over time.
Right, because usually when society talks about building wealth, we're handed this very, linear script.
Yeah, the standard playbook.
Exactly. You get a degree, you secure a salary, you put maybe 10% into a retirement account, and you just wait 40 years.
It's the ultimate slow burn strategy.
It really is. And it relies entirely on this fixed equation, right? Trading your finite hours for a fixed number of dollars. The whole assumption is that wealth is just, accumulated income. But when we look at the data from the ultra-wealthy, that linear progression is completely absent.
It's not there at all.
No. They operate in a completely different mechanical reality. They do not trade time for money. They acquire and they build systems that generate capital completely independent of their physical effort.
And so that is our mission for this deep dive. We are taking a massive stack of research today, insights from financial analysts at Voice of Wealth and ALEX, structural data on real and alternative assets from Wikipedia, and an incredibly dense, data-heavy guide from Brookfield on private real estate.
There's a lot to get through.
A ton. And our goal is to completely redefine what an asset actually is. We are bypassing the traditional, accounting definition. An asset isn't just something a CPA puts on a spreadsheet.
Right.
It's anything that grows in value or generates returns over time. But before we get into the heavy machinery of commercial real estate or private equity, we have to address the engine that generates the initial capital to even play this game.
Because you can't buy a commercial skyscraper if you don't have seed capital.
Exactly. So we are starting with the absolute most overlooked, misunderstood asset class on the board.
Yes. Human capital is the foundational layer. I mean, if we strip away all the financial jargon, wealth creation requires an initial input of leverage.
Right.
And most people just assume that input has to be cash. But the earliest form of leverage you have is your own skill set. The sources are incredibly focused on this concept of asymmetric leverage, specifically high-income skills.
Yeah, those skills that decouple your earning potential from the actual hours in a day.
Exactly.
Let's define that mechanically, though, because I think a lot of people hear high-income skill, and they immediately assume it just means becoming a doctor or a corporate lawyer.
Right, the traditional high-status jobs.
Yeah, but those professions, while obviously high-paying, they are still trading time for money. Like, a surgeon can only perform so many surgeries in a week. Their income has a hard physical ceiling.
The distinction there is vital. A high-income skill, at least in the context of modern wealth building, has two primary characteristics.
Yeah.
First, it involves complex problem solving that basically resists automation. And second, its output scales infinitely at a near zero marginal cost.
Ah, okay.
Take copywriting, for example. If you write a sales page for a product, you do the work once. That page can be read by one person or it can be read by 1 million people.
Right, your labor does not increase.
Exactly. But the revenue generated by that labor does. The same applies to coding software or, digital sales architecture. You are creating a piece of intellectual machinery that runs 24/7.
I mean, let's just look at the math on earning capacity, because it's insane. If you're earning $50,000 a year and you manage to save 10%, that yields $5,000 a year. But if you have a high-income skill and you're earning $300,000 and saving 20%, that yields $60,000 a year.
It's a completely different stratosphere.
Right. Compounded over 30 years at 10%, that is the difference between $1.8 million and $10.8 million.
The math on that compounding effect is just undeniable. But the sources highlight a physiological prerequisite to that software upgrade. And this is something that gets entirely ignored in traditional financial analysis.
Oh, this part of the research was fascinating to me.
Your physical health.
Yes. Because usually health and wealth are treated as two totally separate lifestyle categories. But the ALEX source brings in this massive 13-year study published in the Journal of the American Medical Association.
The JMAS study. Yeah.
Right. They tracked over 1.4 million Americans across various income levels. And the finding, individuals in the top 1% of income live an average of 14.6 years longer than those in the bottom 1%.
It's staggering.
Oh, no.
And most people just view a gym membership or high-quality food or prioritizing sleep as expenses. But the data frames them as high-yielding financial assets.
Definitely.
And it isn't just about the extra 14 years of life, though. Mathematically, an extra decade and a half of compounding interest on a portfolio is an astronomical sum of money. It is about your daily cognitive state.
So let's unpack the mechanics of that cognitive state. How does physical vitality literally translate into better financial decisions, like mechanically?
It all comes down to how the human brain processes risk. When you are chronically fatigued, sleep-deprived, or, operating with high systemic inflammation, your amygdala, which is the fear center of the brain, is hyperactive.
You're basically biologically in a state of survival.
Precisely. So when a fatigued person looks at a potential investment or a business opportunity, their brain is wired to perceive the downside. They see the threat.
Wow.
But when a highly optimized, rested, physically fit person looks at the exact same market data, their prefrontal cortex is fully engaged. They perceive the asymmetric upside. They see the return.
So the exact same market opportunity yields completely different financial outcomes based purely on the physiological state of the investor.
Exactly. And furthermore, the data indicates that physically fit individuals earn roughly 17% more for doing the exact same job, and they are 44% more likely to be promoted. Health is your operating system.
Okay, let's unpack this. Isn't trying to build a massive investment portfolio without focusing on health and high income skills essentially like putting premium racing fuel into a car with a blown engine?
That's a great analogy.
What's the point of the fuel if the machine processing it is just broken? If the hardware is failing, the financial software cannot run.
I agree completely. But once that human machine is optimized, right, the next step is applying leverage to your skills so you don't have to work 24/7.
Which brings us back to that terrifying statistic I opened with. You optimize your health, you build a massive portfolio, and then the Williams Group study shows us exactly how fragile it all is.
Yeah, the generational wealth loss.
Right. They tracked over 3,200 wealthy families over a 20-year period. 70% of those families lost their wealth by the second generation. 90% lost it by the third.
It's wild.
The grandfather builds the empire, the son maintains it, and the grandson completely bankrupts it.
And we are currently sitting on the precipice of an $84 trillion wealth transfer as the baby boomer generation passes their assets to millennials and Gen Z.
84 trillion.
84 trillion. And the Williams Group data shows that this wealth destruction is almost never due to bad stock picks or market crashes or, incompetent tax attorneys.
What is it?
60% of the time, the wealth evaporates due to a breakdown in communication and trust within the family. Another 25% of the time, it is because the heirs were completely unprepared to manage the capital.
So the wealth transfers, but the wisdom doesn't?
The heirs inherit the output of the machine, but they have absolutely no idea how the machine actually works. They haven't been trained in delayed gratification or capital allocation or even just the emotional discipline required to hold volatile assets.
So preparing the next generation is perhaps the longest horizon asset discussed in these sources.
Without a doubt.
All right, so we've established that human capital, your health, your skills, your legacy is the foundation. But having a high income skill still relies on your own individual effort, even if it scales.
True.
To really shatter the ceiling on your earning potential, you have to apply external leverage. You have to stop working one-to-one and start working one-to-1 million. Let's dive into the mechanisms of that digital multiplier effect. The sources point heavily to AI, automation, and attention networks.
Right. So Goldman Sachs recently published a report estimating that AI could automate the equivalent of 300 million full-time jobs globally.
300 million?
Yeah. But the crucial distinction the sources make is that AI itself is not the asset.
Right. I can't just go out buy AI, put it in my brokerage account, expect a quarterly dividend.
Exactly. The asset is your ability to orchestrate the technology. Historically, if you wanted to scale a business, you had to hire a massive team. You had payroll, HR, office space, huge friction, and really high capital requirements.
Right. A massive headache.
But today, a single individual who understands orchestration can act as the central node. They use AI language models to generate marketing copy, algorithmic bots to handle customer service inquiries, and automated workflows via APIs to connect the billing systems to the delivery systems.
You are basically the architect directing an automated 10-person digital team from a single laptop.
Precisely.
So the real danger isn't that AI replaces you. The danger is that a single person using AI replaces an entire department of people who just refuse to adapt. You are taking a traditional 8-hour workday and compressing it into 45 minutes of strategic oversight.
And once you have that level of operational leverage, you can direct it toward capturing the most valuable commodity in the modern economy.
Attention.
Yes. For centuries, the bottleneck to wealth was distribution. If you wrote a book or created a product, you had to beg a publisher or a television network or a retail store to put it in front of people.
They held all the keys.
They held all the power and extracted all the profit. The internet gave us infinite frictionless distribution. But when distribution becomes infinite, the new bottleneck becomes attention.
And the sources cite that the creator economy is currently valued around $250 billion, with projections hitting $500 billion in just 24 months.
It's explosive growth.
Here's where it gets really interesting, though. Is building an audience just the modern digital equivalent of laying down a massive oil pipeline? But instead of transporting oil, you're transporting trust directly to the consumer, completely bypassing the corporate middlemen.
I love that analogy. That is the exact mechanical function of an audience. You are building a proprietary distribution channel. And the economics of this channel are fascinating because of a concept the sources highlight. The 1,000 true fans model.
Right, I've heard of this.
When you control that pipeline of trust, you don't need a Super Bowl-sized audience to generate life-changing wealth.
Yeah.
If you cultivate an audience of just 1,000 people who trust your expertise enough to purchase $100 worth of value from you annually.
Which could be anything, right?
Yeah.
Software, consulting, a digital product.
Exactly. That is a six-figure, high-margin business from just 1,000 people.
And it isn't just digital audiences either. The Voice of Wealth Insights point out that the physical, real-world networks of the ultra-wealthy are arguably their most illiquid but powerful asset.
Oh, absolutely.
Like billionaires like Mark Cuban or Peter Thiel don't find their best investments by scrolling through public stock forums on Reddit.
No. The most lucrative deals on earth never see the public market. They happen through private, peer-to-peer networks based on established trust. Your reputation is a living, compounding asset. Every commitment you honor adds to its equity. Every promise you break drastically slashes its value. In a decade, a person with an impeccable reputation will have access to deal flow, capital, and partnerships that money alone literally cannot buy.
Okay, let's connect the dots here. We have the foundation, health and high income skills. We have the multiplier, orchestrating AI and building a pipeline of trust and attention. Now, we have to actually push something through that pipeline that generates heavy, consistent cash flow.
We need to acquire or build business systems.
Exactly. Let's dive into buying and building cash flow.
This is the transition from human capital to structural capital. And according to the LX data, one of the most asymmetric opportunities right now is small business acquisitions.
Small business acquisitions.
Yeah. The common narrative of entrepreneurship is that you have to start in a garage, invent some disruptive product, grind for 5 years with zero income, and just hope you don't go bankrupt.
The startup hustle.
Right. But the wealthy often bypass that entirely. They simply buy a business that already works.
But hold on. Let's say there is a local commercial plumbing business or a niche e-commerce site that is netting $200,000 a year in pure profit. Why on earth would the owner sell that to me?
That's the logical question.
And more importantly, if they do want to sell it, aren't they going to charge an absolute fortune? Like, where is the hidden trap here?
The demographic data explains the why. The Small Business Administration reports there are 33 million small businesses in the U.S. Right now, 10,000 baby boomers are reaching retirement age every single day.
10,000 a day. Wow.
Millions of them own boring, highly profitable Main Street businesses. They don't want to run them anymore. They're tired. They want liquidity. And their children usually have zero interest in taking over a plumbing supply or, a commercial cleaning company.
Okay, so there is a massive supply of motivated sellers. But how does the math work for the buyer?
Because these are private, illiquid assets, they sell for incredibly low multiples compared to the public stock market. A public tech company might trade for 50 times its earnings. A private, local business typically sells for 2 to 4 times its annual profit.
Oh, wow. So that plumbing business netting $200,000 might sell for $600,000.
Exactly.
But I don't have $600,000 sitting in my checking account. And I'm guessing a traditional bank isn't thrilled about handing out massive unsecured loans to a random person to buy a plumbing company.
This is where the mechanics of seller financing come into play. Because traditional banks are hesitant, the retiring owner often acts as the bank.
Wait, really?
Yeah. You might put down 10 or 20%, say $60,000 to $120,000. The seller holds a note for the rest, and you pay them back over the next 5 to 7 years directly from the profits the business is already generating.
Wait. So the business is literally paying for its own acquisition. I use the cash flow the boomer built to buy the company from the boomer.
Precisely. You are acquiring day one cash flow, using the asset's own revenue to service the debt. And this exact same mechanism applies to digital real estate.
Like websites.
Yeah, platforms like Flippa or Empire Flickers facilitate the sale of cash-flowing websites, automated dropshipping stores, and software-as-a-service platforms. You can acquire a digital asset netting $5,000 a month, apply your high-income skills in SEO or AI marketing orchestration to increase its yield, and then flip it for a much higher multiple.
Okay, let me push back on this, though. Buying a local plumbing business or managing an Amazon FBA store sounds suspiciously like buying myself a really stressful 80-hour-a-week job.
It can be.
Right. If a pipe bursts at 2 a.m. or a supplier in another country suddenly vanishes, I'm the one who has to fix it. At what point does this actually become a passive asset rather than just a heavy, exhausting burden?
A business is not an asset until it can operate entirely without your physical presence. The transition from being an operator to being an investor requires ruthless systemization.
So, SOPs.
Exactly. Standard operating procedures. The moment you acquire the cash flow, your only job is to use that capital to hire competent management and implement those SOPs. If you are still answering the customer service emails or dispatching the plumbers after 12 months, you don't own an asset, you own a job with terrible hours.
Which makes the concept of intellectual property, or IP, so attractive. The sources mention IP as the ultimate scalable asset, citing how Elvis Presley's estate makes $100 million a year, or how J.K. Rowling still gets paid massively.
IP is unique because it is the only asset class where the marginal cost of delivering one additional unit approaches zero.
Right.
You write the software code once, you record the training course once, you write the manuscript once. Whether 10 people download it or 10 million people download it, your labor and production costs remain exactly the same.
You front-load the effort to plant the tree, and you harvest the fruit indefinitely.
Exactly. Franchises are a variation of this too. When you buy a McDonald's franchise, you are essentially licensing a proven IP system. The operational manuals, the branding, the supply chain, so you don't have to endure the friction of inventing a business model from scratch.
Let's look at the financial architecture we've built so far. You optimize your skills, you use AI to scale your output, you build an audience, and you acquire a cash-flowing business or digital IP. You are now generating significant, heavy cash flow.
Yes.
But if you look at the ultra-wealthy, they do not leave millions of dollars sitting in a checking account, letting inflation slowly devour its purchasing power. They take that capital and they anchor it into physical reality.
They move from wealth generation to wealth preservation and multiplication. They seek out structural stability. And that brings us to the core of the Brookfield source material, private real estate.
The anchor. Let's do a deep dive within the deep dive here, because the scale of this market is staggering. Real estate is the third largest asset class globally. The U.S. commercial market alone is valued at roughly $24 trillion.
It's massive.
To put that in perspective, total U.S. equities, the stock market, is around $49 trillion. But here is the massive disconnect. The average retail investor usually has less than 5% of their portfolio allocated to real estate.
Right.
Institutional investors, the pension funds, the endowments, the smart money, often allocate well over 10%. Why are regular people so underexposed to one of the largest asset classes on Earth?
Historically, it was purely a barrier to entry. Buying a 50-unit apartment complex or a commercial logistics hub required immense upfront capital, deep operational expertise, and a willingness to tie your money up in an illiquid asset for a decade.
It was a gated community for the ultra-rich.
Exactly.
Yeah.
But the Brookfield data doesn't just outline the scale. It breaks down exactly why institutions fight so hard to be in this asset class. They detail 6 enduring advantages. And we really need to walk through the mechanics of each one, because it fundamentally changes how you view property.
Okay, let's start with advantage number 1, consistent income.
When you buy a growth stock in the public market, you are generally relying entirely on price appreciation. You buy it at $50, you hope it goes to $100, and you sell it.
Right.
With private commercial real estate, a massive portion of the total return is generated through contractual recurring rental income. Between 2003 and 2024, the data shows that this steady cash flow was the bulk of the total returns, acting as a massive stabilizing force regardless of what the broader economy was doing.
Which directly creates advantage number 2, lower volatility. I want to dig into the data here because it's so counterintuitive. Over the last 10 years, the standard deviation, which is how academics measure the violent swings of an investment for private real estate, was only 5.6%.
Very low.
But public real estate, like REITs that trade on the stock market, swung by 18.1%, and U.S. equities swung by 15.7%. If a public REIT and a private real estate fund own the exact same types of buildings, why is the public version 3 times more volatile?
Because public REITs are priced daily by the emotional mania of the stock market. A bad macroeconomic headline hits the news, algorithmic trading bots panic, and retail investors sell off their shares.
So the price tanks.
Exactly. The public REIT can drop 10% in a single afternoon, even though the physical buildings haven't moved and every single tenant still paid their rent that morning. Private real estate completely insulates you from that daily market sentiment. Its value is calculated periodically based on actual long-term fundamentals, the net operating income, the cap rates, the physical occupancy.
So what does this all mean? If public equities are like a speedboat fast, but you feel every single wave and you might get thrown overboard in a storm, private real estate is like a massive commercial cruise ship.
I like that.
It's built with structural shock absorbers so you don't spill your drink when the market gets choppy.
That structural shock absorption leads perfectly into the third advantage: risk-adjusted returns. The Brookfield data models a traditional 60-40 portfolio, 60% stocks, 40% bonds. Historically, that returned about 6.9% with a risk metric of 10%.
Okay.
But when you carve out just 10% of that portfolio and allocate it to private real estate, the math changes. The overall return historically increased to 7.1%, while the risk metric actually dropped to 9.1%.
Wait, you are achieving a higher return while taking on less mathematical risk. That feels like a financial magic trick. How is that mechanically possible?
Because of advantage number 4. Diversification and low correlation. Private real estate operates on completely different economic drivers than stocks or bonds. When the stock market crashes, commercial real estate often remains stable, or occasionally even goes up. It just doesn't move in tandem with Wall Street.
And it also doesn't get crushed by inflation, which is advantage number 5. In fact, real estate seems to weaponize inflation.
It really does.
The data shows that when inflation is greater than 2.5%, private real estate has historically averaged a 2.2% return, while fixed income like bonds collapse to nearly 0. Explain the mechanics of how property actually feeds on inflation.
It is a dual-sided mechanism. First, as inflation drives up the cost of labor and raw materials, it becomes prohibitively expensive to build new properties. This restricts new supply, making existing properties inherently more valuable.
Makes sense.
Second, landlords can adjust lease agreements to scale with inflation. But the true secret is the leverage. Most real estate is acquired using fixed-rate debt.
So if I buy a building with a fixed mortgage and inflation spikes to 8%, my mortgage payment stays exactly the same. But I am raising the rents by 8% to match inflation, and the physical value of the building is inflating.
You've got it.
The bank's debt is literally being eaten away by inflation while my cash flow expands.
Exactly. It is one of the only asset classes where inflation actively accelerates your equity position. Which brings us to the final and arguably most powerful advantage, the tax yield. The U.S. tax code is essentially a blueprint written by property owners for property owners.
I've heard real estate investors say they can make hundreds of thousands of dollars in cash flow and legally pay 0 income tax on it. Walk me through how that actually works, because to a W-2 employee paying 30% off the top of their paycheck, that sounds illegal.
It sounds crazy, but it relies on non-cash deductions, primarily a mechanism called depreciation.
Okay.
The IRS acknowledges that physical buildings degrade over time, so they allow you to deduct a portion of the property's value against your income every year as an expense, even if the property is practically appreciating in market value.
So it's a paper loss.
Exactly. And advanced investors use strategies like cost segregation, where they accelerate that depreciation by breaking down the building into components, the HVAC system, the carpeting, the lighting, and depreciating them rapidly. This paper loss offsets the actual cash flow, meaning the income you receive is largely classified as a tax-deferred return of capital.
And when you finally want to sell the building and buy a bigger one, you don't pay massive capital gains taxes either, right? You use a 1031 exchange.
Correct. Section 131 of the tax code allows you to sell an investment property and seamlessly roll the entire profit into a new, larger property without triggering a taxable event. You simply defer the taxes indefinitely while continually trading up to larger assets.
So, if you are looking to deploy capital into this space, what are the actual strategies? The Brookfield Guide categorizes private real estate into 4 distinct buckets: core, core plus, value add, and opportunistic.
Think of these as ascending levels on a risk-to-reward spectrum. Core real estate is the safest. These are brand new, fully occupied office buildings or luxury apartments in major metropolitan centers. They offer highly predictable, steady cash flow, but the potential for massive appreciation is low.
Okay.
Core Plus is slightly higher risk. Maybe the building is 10 years old and needs minor cosmetic upgrades to push the rents higher.
And value add is where you really get your hands dirty.
Yes. Value add involves acquiring an underperforming, mismanaged property. Maybe the occupancy is low, the units are outdated, and the current landlord isn't pushing market rents. You buy it, inject capital to fully renovate the interiors, install better management, and dramatically force the value of the property up by increasing the net operating income.
And the last one.
Finally, you have opportunistic. This is the highest risk. This is ground-up development, taking a dirt lot and building a high-rise or buying a deeply distressed abandoned warehouse to convert into luxury lofts. You might see zero cash flow for 3 years during development, but the ultimate multiplier on your capital can be enormous.
Now, obviously, historically, an everyday person couldn't just casually participate in an opportunistic high-rise development, but the regulatory landscape is shifting. We are going to get into the exact mechanics of how regular investors are accessing these funds in a minute.
Right.
First, we need to zoom out. Real estate is the king of physical assets, but it isn't the only tangible asset investors are using to escape the volatility and inflation of the traditional banking system.
No, it's not. This brings us to the broader category defined by the sources as real and alternative assets. By academic definition, a real asset is something with inherent, intrinsic physical worth. We are looking at global infrastructure, energy pipelines, and natural resources.
Right.
And within this category, one specific asset stands out for its unique defensive characteristics: farmland.
The ultimate finite asset.
Yeah.
The Alex source brings up an interesting point. Warren Buffett owns a 400-acre farm in Nebraska. Bill Gates is currently the largest private owner of farmland in the United States. Neither of them are out there driving John Deere tractors. Why are the wealthiest tech and finance minds buying up dirt?
Because productive agricultural land possesses an economic characteristic almost nothing else on Earth shares. Absolute finite scarcity paired with perpetual unyielding demand.
You literally cannot manufacture more arable land.
Exactly. In fact, due to urban sprawl and soil degradation, the supply of arable land is slowly shrinking. Simultaneously, the global population is growing, meaning the demand for caloric output increases every single year.
The data on this is wild. The NCIF index, which tracks institutional investment in farmland, shows that over a 33-year period from 1991 forward, U.S. farmland averaged a 10.29% annual return. It essentially paced or beat the Dow Jones over the same period.
But the average return isn't even the most important part of that data. It is the floor.
Oh, right.
Over that same 33-year timeline, the worst year for the Dow Jones was a catastrophic negative 41.3%, a massive destruction of wealth. The absolute worst year for farmland during that entire 3-decade span, positive 2%.
The floor never collapsed. Why?
Because of the inherent utility value. A stock certificate is only worth what the market psychology dictates on any given day. A plot of fertile farmland fundamentally produces food. It generates a biological yield that human beings require to survive.
So even during a massive economic recession, people might stop buying iPhones, but they do not stop consuming calories.
Exactly. It provides an almost impenetrable floor to the asset's value.
And if we are talking about impenetrable floors and defensive posturing, we have to look at the macroeconomic context the source is present regarding currency. Now, to be incredibly clear to you listening, we are strictly reporting the historical patterns detailed in the sources. We are not taking a political stance on fiscal policy. But the sources highlight a historical reality. Over a long enough timeline, governments expand the money supply. They print fiat currency to manage sovereign debt. And the mechanical result of that is the dilution of purchasing power for any cash sitting in a standard savings account.
It is an objective historical pattern of monetary systems.
Hmm?
As the supply of a currency expands, the purchasing power of each individual unit decreases. This is precisely why institutional wealth mandates an allocation, usually 5 to 10% of a portfolio, into alternative stores of value.
They aren't trying to hit a home run with that money.
No, they do not buy these assets to get rich quickly. They buy them as an insurance policy against the systemic dilution of their fiat reserves.
And the sources list the classic examples. Physical gold, which has maintained its purchasing power across empires for 5,000 years simply because it requires physical energy to mine and cannot be printed by a central bank. They bring up Bitcoin, framing it mathematically as digital gold, a decentralized network with a hard cap supply of 21 million coins, immune to arbitrary inflation. But then the sources list collectibles, vintage Rolex watches, classic Ferraris, and fine art.
Collectibles function as stores of value through extreme scarcity combined with high cultural demand. A vintage Patek Philippe watch or an original Banksy painting is a one-of-a-kind artifact. The supply is permanently fixed.
I need to stop you there and push back hard on the art aspect because the math in the sources is completely contradictory.
How so?
They reference a famous 410-year study by William Baumol. It showed that the average real annual return on art was only 0.55%. Another Swedish study looking at art from 1985 to 2016 showed a meager 0.6% annual return.
Okay, I see where you're going.
If fine art barely outpaces inflation and generates a 0.5% return, why are billionaires parking tens of millions of dollars in Picassos? Is this just a massive ego play to show off at dinner parties? Or is there a hidden mechanical advantage that normal people don't see?
It is entirely mechanical. The ultra-wealthy are utilizing three distinct advantages that art provides. The first is the illiquidity premium.
The illiquidity premium?
Yes. Because a $50 million painting takes months to authenticate and sell at auction, it is incredibly illiquid. Ironically, this protects the asset during a financial panic. You can panic sell $1 million of stock on your phone in 3 seconds when the market drops. You cannot panic sell a Picasso. The illiquidity prevents volatility.
Ah, I never thought of it that way.
The second advantage is the aesthetic dividend. A stock certificate sits in a broker's server. A masterpiece hangs on your wall. You derive daily utility and status from it while it preserves your capital.
Okay, those are nice side benefits, but they don't explain the massive capital allocation. Where is the financial leverage?
The true leverage is in collateralization. It is a strategy often referred to in wealth management as buy, borrow, die.
Buy, borrow, die. Unpack that.
When a billionaire buys a $40 million piece of art, they have no intention of ever selling it. Selling it would trigger a massive capital gains tax bill. Instead, they take the artwork to a major banking institution. The bank appraises it, puts it in a secure, climate-controlled vault, and issues a line of credit against the art for, say, $20 million at an incredibly low interest rate.
Because the loan is secured by a flawless asset.
Exactly. And here's the magic trick. Debt is not taxable. The billionaire now has $20 million in tax-free cash to fund their lifestyle, buy another business, or invest in higher-yielding private equity.
Wow.
The art continues to appreciate slightly in the vault, preserving the base capital. When they eventually pass away, the debt is settled by the estate, often taking advantage of step-up basis tax loopholes, and the heirs inherit the remaining value. They access the liquidity of the asset without ever triggering the tax penalty of selling it.
That is next-level financial engineering. But, for the listener right now who has built their skills, scaled a business, and maybe acquired a duplex, but doesn't quite have $40 million to deploy into a vault at Sotheby's.
Right. The rest of us.
We need to look at the financial flywheels that are actively multiplying wealth for everyday investors. Let's move to the final piece of the puzzle. The massive compounding engines of equities and private equity, and how it's all being democratized.
Let's analyze the public markets first. The Alex data presents a staggering reality check regarding the stock market. Over any given 15-year period, roughly 85% of highly compensated active money managers, the Wall Street professionals with armies of analysts and supercomputers, fail to beat the S&P 500 index.
Stop and think about that. 85% of the literal experts lose to the average baseline of the market.
It mathematically demonstrates that trying to aggressively day trade or handpick winning stocks is a losing proposition for almost everyone, largely due to management fees, transaction costs, and sheer market efficiency.
So what's the alternative?
The true, reliable engine of wealth creation in the public markets is the boring miracle of the broad market index fund. paired with dividend reinvestment.
Let's walk through the mechanics of that automated flywheel. When you buy a broad index, you own a tiny slice of the 500 most profitable companies in the country. Many of those companies distribute a portion of their quarterly profits directly to shareholders as a dividend.
And if you set your brokerage account to automatically reinvest those dividends, using the cash to buy fractional shares of the index, you create a perpetual motion machine.
It just feeds itself.
Exactly. The asset generates cash, the cash buys more of the asset, which generates more cash. If you put $10,000 in the S&P for a child, and they just leave it untouched, compounding over generations, it could become 4 million billionaires for their grandchildren.
But if the S&P 500 is the slow, highly probable, boring miracle, private equity and angel investing are the high-octane rocket fuel. The sources highlight that private equity has historically crushed the S&P 500 by a factor of 4 over the last 2.5 decades.
By a factor of 4.
Yeah. Angel investing is essentially acting as a talent scout. You write a check to a startup when it is just 3 founders and an idea. If they become the next Uber or Airbnb, you make 10, 50, or 100 times your initial capital.
We must heavily emphasize the mechanical risk here, though. The venture capital world operates on a power law distribution. Unlike index fund, where you expect everything to grow slowly, in angel investing, you expect 95% of your investments to go to absolute zero.
They will fail completely.
Yes. The strategy relies on the one massive winner out of 100 paying for all the losers and generating the entire fund's return. There is a dark joke in Silicon Valley that the first $25 million you lose in private equity is just your tuition for learning how the game actually works.
I have a theory on this, and I want you to validate it based on the data. If private equity is outpacing the public stock market by 4 times, doesn't that fundamentally mean the public stock market is basically just the leftover scraps?
What do you mean?
Well, 20 years ago, companies went public early. Every day, people could buy Amazon or Microsoft stock while the companies were still relatively small, and the public caught the massive wave of growth. Today, companies stay private for a decade. Private equity firms pump them full of capital and extract all the explosive growth. By the time a company like Uber finally has an IPO and the general public can buy the stock, hasn't all the life-changing upside already been consumed by the private investors?
Your analysis is entirely correct. The most significant wealth creation has shifted from the public markets to the private markets over the last 2 decades. And historically, this was an impenetrable fortress. The government gate-kept private equity through accredited investor laws, meaning you legally had to already be a millionaire to invest in the highest-yielding assets.
But the Wikipedia source highlights a massive structural change happening right now, the democratization of private capital. The gates are finally being forced open.
Yes. Due to recent massive regulatory shifts globally, the financial tools of the ultra-wealthy are being handed to the retail public. In the United States, we saw Title III of the JBS Act.
Hold up. Title III of the JBS Act. What does that actually mean mechanically for the person listening?
Mechanically, it means a non-accredited investor, a regular person with a median income, can now legally log on to an equity crowdfunding platform like AngelList or Republic and invest as little as $100 into a private tech startup. They can pool their capital alongside the massive venture capital firms.
And it isn't just the U.S. The sources mention the LTIF 2.0 framework in Europe and the SIAs and EIs funds in the UK.
Correct. LTIF 2.0 stands for the European Long-Term Investment Fund. The recent updates to this framework removed the massive minimum investment hurdles, allowing everyday European citizens to allocate capital directly into private infrastructure projects, private debt, and real estate.
And the UK ones.
In the UK, the Seed Enterprise Investment Scheme, or SEIS, offers retail investors incredibly aggressive tax reliefs, sometimes up to 50% of their investment back in income tax relief, simply to incentivize them to invest in early-stage private British companies.
Furthermore, the public markets themselves are creating proxy vehicles to access these assets. The sources mention public ETFs like VRAI, the Virtus Real Asset Income ETF, and RLY, the SPDR Multi-Asset Real Return ETF.
Right, ETF wrappers.
Yeah. If someone doesn't want the hassle of buying a physical farm or finding a private real estate syndicate, they can simply buy shares of these ETFs in their standard brokerage account and gain instant, low-cost exposure to a diversified basket of global real assets, infrastructure, and natural resources.
Yeah.
The access problem has been solved.
It truly has. The barriers have fallen.
Yeah.
You now have the ability to architect a portfolio that mimics an institutional endowment.
Okay, we have covered an unbelievable amount of ground today. We have torn apart the traditional linear path of wealth and rebuilt it. Let's trace the architecture we've mapped out.
Let's do it.
You start with the absolute bedrock, optimizing your biological hardware for peak cognitive performance and upgrading your mental software with high-income skills that decouple your earning from your time.
Right.
You apply extreme leverage to those skills by orchestrating AI tools and building proprietary pipelines of human attention. You take the massive capital generated by that leverage and you acquire cash-flowing systems, buying seller-financed businesses or building zero marginal cost intellectual property.
And then the physical anchor.
Exactly. Then you step out of the digital ether and anchor that wealth into the physical reality of private commercial real estate and finite farmland, utilizing inflation-hedged debt and the tax code to preserve the capital. And finally, you accelerate the entire structure by plugging into the automated compounding of index funds and the newly democratized high-octane world of private equity.
It is a mathematically sound, historically proven blueprint. But we must leave you with one crucial realization. The wealth gap in the modern era is no longer an information gap.
That's a great point.
Historically, the mechanics we discussed today were secrets guarded by family offices and private bankers. Today, the information is ubiquitous. You possess the blueprint. The gap that separates the wealthy from the rest is purely an action gap.
The execution gap.
Exactly. It is the vast psychological distance between understanding how a 1031 exchange or a high-income skill works and actually initiating the friction required to execute it. Most people will consume this deep dive, feel a surge of intellectual inspiration, and wake up tomorrow to do the exact same things they did yesterday.
So what's the challenge?
Our challenge to you is to break that cycle. Review the mechanics of these 15 or so assets we've discussed. Select just 3 that align with your current capital and risk tolerance, and focus relentlessly on acquiring them over the next 90 days.
That is the execution gap. And I want to leave you with a final provocative thought to mull over on your own, something that builds on the mechanics we've discussed today, but pushes it even further into the timeline. We talked about how AI is currently a tool for orchestration, but if artificial intelligence eventually automates all complex intellectual labor, if software, legal analysis, digital marketing, and digital assets become virtually free to generate at scale, will the very definition of a high-value asset shift entirely backward.
Wow.
In a future flooded with infinite, costless synthetic intelligence, perhaps the only true scarce assets left on the planet will be a plot of fertile, physical farmland and your reputation as a deeply empathetic, trustworthy human being. So as you optimize your financial machine, make absolutely sure you don't neglect the humanity of the engine. Thank you so much for joining us on this deep dive.